Hey everyone, I want to wish you guys a Merry Christmas. And I also wanted to bring up that this is a follow up video to a video I made exactly a year ago. Wow, an entire year has passed. And if you guys remember, a year ago, I was advising everyone to exit their stock positions. And it wasn't just a one time announcement, it was a this is the key point. We're at the peak. Don't wait any longer to get out. I also had some other videos throughout the year saying, hey, I think this is a temporary low, or this is a bear market rally. It's a chance to sell if you haven't. But we're just going to mainly focus on what's occurred in the past year. So, late December of 2021, I advised everyone to get out of their stocks. And so, we're going to talk a little bit about why it's so important to not lose money when you're investing. And this is something that I have learned from my 40 years of studying investing myself, and also learning the hard way at times. And I just want to share this wisdom with you. And if you want, it's going to be kind of generic and basic. But if you want something more detailed, you can always reach out to me. I love helping people. So, what I have pulled up here is the Dow Jones Industrial 1 year chart, because 1 year ago is important because the Dow was at basically 37,000, and we had a really tough year, basically lower highs, lower lows, all up until about October. And then the Dow has really rallied since October, but it's rolled over again since. And this kind of coincides with high interest rates, because interest rates do affect stocks. That's not what this video is about, but I may go into that in another video. So in the past year, we're down a little over 8% in the Dow Jones Industrial. We hop over to the S&P 500. That's what we have here. And we have a 1 year chart as well. And the 1 year chart of the S&P, it was around 4,800. It's lost almost 1,000 points, and it's close to being down 20% year over year. And as you can see, lower highs, lower lows. Ever since I said in December, I said, don't wait for January to get out. I made a video in January too. I think it was right here. First or second week of January, saying, hey, you got one more chance to get out near the highs. Once again, we hit some lows in the S&P around just below 3,600, and we rallied, and we're rolling over again, down almost 20% on the S&P. The NASDAQ, the high flyers, boy, have they taken a beating over the past year. They are down 5,300 points. They were just over 16,000 when I recommended getting out of the NASDAQ. The NASDAQ has not had as good a luck having rallies as high as the other indices. It is down over 33% this year. So if you are in tech stocks, Tesla, Amazon, stocks of that type, the list goes on and on, they are down 30, 40, 50% this year. So I just wanted to share that as a 1 year reminder of where we have been and where we are. I still think there's a lot of pressure on stocks, even though generally when stocks have this bad of a year, the following year is a bounce. But that's not just a general rule of thumb. You have to look at what the headwinds are. And we have some serious headwinds for stocks. All right. I want to show one other thing before I go into the real depth of today's video. And so let me drop this down. This is just, I've been extremely busy here for the last 2 months, but I have made some trades. And this is my trades account. It's not edited. This is the actual buys and sells. And what I want to show here is that you can make money if you just can't avoid trading and you have to trade to satisfy yourself. You can make money while things are going down. So I bought some short NASDAQ ETFs. I was buying those in October, and then I was unloading them in early November. Now, could have I made more? Yes. But as you can see, I was buying at 49 and I was selling at 54, 55. I sold some at 57.9 and I sold some at just under 61. At the same time that was going on, I was also bullish silver. That is AGQ. I was buying AGQ and selling it on the way up. Bought at 20 and 22, sold at 23, 24. Obviously, I wish I would have waited longer, as AGQ, the silver ETF, is now at 31. So this could have been some extremely profitable trades, not just 10 or 15% returns. They could have been 50% returns. But I'm a fan of going for the small wins and just banking them. So the reason I'm making the video today is because it's something that I have. So I have studied in depth investing for 40 years. And you might go, 40 years? How did Jason do that? I've been doing it since I was 12, so actually a little over 40 years. And I've actually been investing as well, not just studying it. And something I want to show you here is, sorry about that. We'll get it right here. So the title is Why Low Risk and Steady Returns Matter. And I think this is really important, especially what's occurred in the last couple years with crypto, with Tesla, with all kinds of crazy high-flying stocks. I said a year or two ago that this reminded me so much of 99-2000. I couldn't believe it. And if you actually look at how the stocks are performing, Carvana, Redfin, Zillow, Peloton, they're behaving just like 2000, 2001. The high flyers are getting crushed. And the reason that this matters is because when high flyers are going up 50, 100% a year and doubling every year or two and then quadrupling and eight-tupling, you look like a superstar if you're in that particular stock, right? And what I wanted to show here is you feel like a fool, you know, if your friends have a percentage of their income that's doubling and quadrupling and septupling, and you're only making 10, 15% on your money. But this is why slow and steady wins the race. I want to show you something here. I call it the tale of two investments. And like I said, I've studied this greatly, and there's a lot of very successful investors who have learned in their lifetime that steady, slow, and methodical is the winning route, especially if you have any anticipation of living for any period of time at all. So something I've chosen here, what I wanted to show was 6-year returns. And the reason I felt that was important is I feel it's very achievable to get 12% average annual returns investing. All kinds of ways. It's not anything specific. There are specific ways you can do it, but also there's ways that people can do it in what they like and what they enjoy and what they want to follow. But if you can make 12% a year for 6 years, 12 times 6 is 72. And why that's important is there's an investment philosophy called the rule of 72. And the rule of 72 is you end up doubling your money. I know right here I only show plus 99%, so 1% shy of doubling your money. But let's just presume that every 6 years you can double your money through some type of investment that you are active in and not greatly active. Don't be fooled by these silly trading platforms that make you think you have to trade monthly, weekly, or daily. I can show to you, I can prove to you that you can make 12% annual returns making trades a handful of times a year, less than 10, possibly some years not making any trades at all. How amazing would that be? You invest in your investments and you ride them out. You don't even have to think about them. Go enjoy the cocktail parties, go enjoy the vacations at the beach. Let your investments work for you. So, slow and steady, 12% a year. Risky, high reward looks pretty fancy. This is basically kind of like the NASDAQ. Look at this. We got some plus 25, plus 35. We even have a year of plus 45 in here. These are just some estimated annual returns. And you look like a super stud when you're making, 35, 45%, and everyone else is making 10 to 15. You get to be braggadocious all year. What I did here is I created a 6-year return for something high risk and something steady and slow. And I gave it, this one has a lot greater variability in its returns, but it's still gross returned plus 75%. So if you take the annual returns, add them up, so the negatives subtract, the positives add, you get plus 75. Same over here on the steady and slow, plus 75. Now, this is where it gets super, super important that you must see this. The net returns. So the gross returns look identical. And actually 3 out of the 6 years, the risky high reward beat the slow and steady handily. I'm talking handily here. Look at this, plus 35 compared to plus 15. And the slow and steady only won 2 years, and then they tied in year 6. They both were up 15 in year 6 is what I estimated. What this gives you is a net return. So if you invested $10,000 here before year 1, the net return is only 69% for the risky, which means you have 16,900. The steady, slow, and methodical is just shy of 100% return, which means you have 19,900. Even though they both had the same gross returns. And that's because negative years are the death blow to long-term growth. Negative 33%. Negative 20%. What did I just say? Negative returns are the death blow to long-term wealth growth. So let's presume that you have 30 years of great income earning capability. Doesn't matter whether it's from 20 to 50 or 30 to 60. And you're able to put money away for those 30 years. If you make 69% on your money every 6 years, which is actually very, very good, at the end of the 30 years, you'll have 13.8 times what you started with. Which, in all reality, in 30 years, you beat inflation, but by how much? Maybe double, maybe triple. So you do win, but things that cost $10,000 30 years ago cost $40,000, $50,000 today. So it's better than just taking your pieces of paper money and stashing them somewhere. But you can add this up. So if you have 5 returns with 69% 6-year returns, you'll end up with 13.8 times your money. So 10,000 would become, what does 10,000 become? 138,000 under the risky high reward. And 60, 70, 80% of the time you get to brag about how you're a superstar and how some of your stocks doubled and some tripled and some quadrupled. while boring over here, Mr. Steady, Slow, and Methodical, investing in boring businesses, had the same gross returns, but because he had less drawdowns in the negative years, his net returns were close to 100%. And what that created for him is, or her, over 30 years, 5 of these 6-year investment timeframes was 64 times the original investment of $10,000. And 10,000 times 64 is $640,000. And this may look like something that you're like, yeah, whatever, Jason. Well, I'm in my 50s now, and I started investing pre-teen, and I have seen everything in between here and even a little worse, and here and better. So don't poo-poo this. Don't shake your head at it. Don't say this is hypothetical and may not happen. It does happen. And if you were able to put 10,000 in the first 6 years, and then now obviously the next 6 years, you only get 32 times return. So the first 10,000 you get in there returns you 640,000. The next 10 returns you 320,000. Don't belittle this. This is massive differences, life-changing, basically, not just for yourself, but for your family. For a $10,000 investment to be worth $640,000 versus $138,000. And yes, I know there's all kinds of craziness. The government does crazy things now. They hand out free money. They wipe debt clean. They make interest rates 0. But still, through all of that, you can achieve these results. And yeah, I just wanted to share that with you today, to not be defeated by what's going on now here in the stock market. This is the S&P and the NASDAQ, but make quality decisions. And let me show you something here. Realize when something is doing something crazy like this, when you have an indice that's of hundreds of stocks, it's going from 7,000 to 10,000 over 3 years, then has a sharp decline, but then goes from 7,000 to 10,000 took 3 years, 40% return. You have to question when it goes from 6,000 to 16,000 in a little over 1 year, right? That's, what is that? That's 150% return. You really have to start going, is this really how it's going to play out long term? And one of the ways that you can always tell that an insane bull market is running out of steam, this looks really small right here, but I'm going to show you something, is the first leg up. There's 3 legs. They call it A, B, C. First leg up is A. Second leg up is B. Now on this one, B almost matched A. You can see that this move right here almost matched this move. But as soon as we got to C, the C leg, you can see it started being more laid out, less vertical, more horizontal. In fact, had a hard time getting higher. It wasn't the same trajectory. As soon as you start seeing that, that lets you know that it's running out of steam. That's why right in here, the summer of 2021, I was saying, hey, this is getting towards the end. We had a dip and we had another crazy moonshot in November, December. And I said, you got to get out. This doesn't make any sense. So you can see back over here in 2017-18, we had something similar. You can see how it was going up and going up. And look at this. It was a very long, drawn out, and it was starting to become more horizontal right here. And then it dropped. So there you go. Now, here's what's interesting. we have the A leg down, right? Very steep. The B leg down, very steep. A rally. This is kind of the C leg here, maybe a little more C, but you can see already we're already starting to experience less sharp declines in the NASDAQ. So leg one here was, how far was it? Wow, it was about 3,500 points. And then this one was about 3,500 points. So we peaked out here around 13,000. So, uh, don't know. We may start stalling out here because it's kind of the opposite of what we have here, right? Two strong legs up, followed by a weak leg up. Two strong legs down, followed by a weak leg down. I, I'm not saying to hop into the stocks because I actually still believe with interest rates where they're at, and you can find all kinds of people talking about the analysis on that. But you can think about that. If you would have sold here, right, at 12, 13,000 NASDAQ, your friends would have made fun of you or the media would have made fun of you because it kept going up. But here you are almost 2 years later and you'd have 20% more money. So yeah, you missed the crazy run up to the peak, but you've been on the sidelines, and you haven't actually been on the sidelines because I advised everyone who I'd said to get out here. And oh my gosh, I had so many people saying, what do I do? What do I do with my money? And I told them just to wait, to be calm. And it was so crazy. Every week or two, they couldn't believe I was telling them to stay calm and not invest. So we waited until summer when you could start getting 3-4% on your money in treasuries. And so basically you avoid the declines, you take your money, you move it over to treasuries, and everyone's made 2-3-4% this year playing the safe game, while those playing the risky game are down 33%. And that's where you really draw your gains from the risky people. So this year, the risky people have lost 30% of their money. The safe people have made 5%. You've gained 3-4 years of an investment time on the risky people. So just wanted to share that. I know I like to talk a lot about houses. I love to talk about investing. I've got all kinds of investment ideas. I have long-term ones, short-term ones. I'm right multiple times more than I'm wrong. And I just want you to know that, and that you can short the stock market if you want. It's kind of dangerous. It's kind of fun. But if you just want to sit on the sidelines, you know what? That's fun too. I've actually been on the sidelines for the past month, and it's been wonderful. I missed out on making some money on the short side, but I wasn't long at all. The stock market's gone down 5-6% this month, so which is very negative for a December. But hope you guys have a wonderful Christmas and happy holidays. And like I said, if you ever want to reach out to me and talk one-on-one, I'm here for you. I hope to live another 20-30 years, and I would love to advise people, help them get to 64x on their money from here. Love to have some 30-year-olds looking for some advice and wisdom. And it's super calm. That's what's so crazy. I exited the majority of the market in 2018. And trust me, I felt like a fool for a while. I think the S&P was 2,800. And I looked pretty good up until post-pandemic, when the S&P was at 2,000, I think, in March. So I looked really smart. I put it in investments that paid 4 or 5% a year, and then the S&P went to 4,800. So I looked kind of dumb. But now looking back, so we're 4 years removed, and the S&P is up 1,000 points, which is 30%. But since 2018, I've made almost 100% on my money in my investments. So although I missed out on a 30% return in the S&P over the last 4 years, I calmly marched forward to 100% gains in safer investments. All right, thank you guys. Take care, and choose simplicity, and choose calmness, and choose less stress.